depreciation recapture can feel like a hidden tax trap for property owners and investors. While depreciation gives you valuable tax savings during an asset's life, selling that asset can trigger a tax event that impacts your bottom line. In this video, we'll explain depreciation recapture, how it's calculated, and share strategies to minimize its impact. Let's get started. First, let's define depreciation recapture. When you sell an asset, such as property or equipment, for more than its adjusted basis, the IRS requires you to recapture the depreciation you've claimed as taxable income. For example, if you purchased equipment for $100,000 and claimed $40,000 in depreciation, the adjusted basis is $60,000. Selling the asset for $90,000 means $30,000 is subject to depreciation recapture. Understanding this concept is key to navigating the tax implications of asset sales. For real estate, depreciation recapture is taxed at a maximum rate of 25%, applied to the portion of the gain linked to depreciation deductions. For non-real estate assets, such as equipment or vehicles, the recapture is taxed as ordinary income, potentially at a higher rate. To calculate the recapture amount equals sale price, adjusted basis. This amount is added to your taxable income and could push you into a higher tax bracket. Let's break down the tax rates. 25% for real estate depreciation recapture. Ordinary income rates, up to 37% for other depreciated assets. Knowing these rates helps you plan for the tax impact when selling assets. Now, let's discuss strategies to minimize depreciation recapture. Number 1. Utilize a 1031 exchange. Defer depreciation recapture taxes by rolling proceeds into a like-kind property. A 1031 exchange is one of the most effective tools for real estate investors. Number 2. Structure installment sales. Spreading out the sales proceeds over several years can help you stay in a lower tax bracket and reduce your annual tax burden. Number 3. Reinvest in the property. Instead of selling, consider upgrading or improving the property. This increases its basis and reduces the potential gain upon sale. Number 4. Offset gains with losses. If you own other depreciated assets, sell them in the same year to offset gains. This reduces your overall tax liability. Now, let's address some common misconceptions. Myth: depreciation recapture only applies to real estate. Fact: it applies to all depreciable assets, including equipment, vehicles, and machinery. Myth: you can avoid recapture by not taking depreciation deductions. Fact: the IRS assumes depreciation was taken, whether you claimed it or not. Depreciation recapture can feel complex, but understanding how it works and planning accordingly can save you money. Strategies like 1031 exchanges, installment sales, and offsetting gains with losses are just a few ways to manage its impact. Before selling a depreciated asset, consult a tax professional to explore your options and make the most tax-efficient decision. With the right planning, you can minimize depreciation recapture and maximize your savings.